Thank you all for joining us today for the annual general meeting of the Biotech Growth Trust. So my name is Geoff Hsu. I'm one of the co-portfolio managers of the Biotech Growth Trust. I've been a portfolio manager of the trust since May of 2005. I'm a general partner at OrbiMed. My colleague, Josh Gollum, is also a partner at OrbiMed, and both of us basically manage this trust. Josh is going to be available for Q&A via Zoom after my presentation. And each of us actually has over 20 years of experience investing in the biotech sector. So just to give you an update on OrbiMed, the firm that we work for, we are a global healthcare dedicated investment firm with over 25 years of experience investing in the healthcare sector. We manage over $17 billion in assets right now across multiple business lines shown in the pie chart on the left. And you can see that the Biotech Growth Trust, as well as its sister trust, the Worldwide Healthcare Trust, collectively make up a majority of our public equity business. We have 145 global employees that collectively have over 300 years of investment experience. We are continuing to grow as an organization, making over 30 new hires since 2023, and 34 of my colleagues have either an MD or PhD degree, so we have a lot of technical expertise in-house. So I know we've had some challenging performance recently, but I do want to emphasize that we do believe that we have a differentiated platform capable of delivering strong returns for our shareholders. We have a true global footprint, so we have 12 locations worldwide, including New York, San Francisco, Hong Kong, Shanghai, and London. That means that we can invest anywhere in the world, whether it's Europe, US, Asia, and that provides a lot of geographic diversification for the portfolio. I would also note that we are seeing lately a lot of innovation in biotech coming out of China. We are one of the few funds and firms that actually have dedicated analysts based out of our China offices in Hong Kong and Shanghai who are doing diligence on those Chinese healthcare companies. We have a relatively large research team with 6 dedicated biotech analysts, including myself and Josh, with collectively over 60 years of experience. And we also draw on the expertise of 7 other public equity analysts covering other subsectors of healthcare. As one of the long-standing investors in the healthcare space, we also get preferential access to deal flow. What this means is that when a biotech company wants to do a financing, they will typically reach out to just a handful of investors in order to do that deal, and we're one of the few firms that typically gets wall-crossed on those opportunities. So we get wall-crossed on 3 to 4 deals per week. What that means is that they reach out to us confidentially saying, we're looking to raise a round of financing, are you interested? Typically, they'll actually, in some cases, share confidential information that has not been publicly released yet, whether it's clinical trial data, FDA correspondence, and so forth. We're then restricted from trading in the stock for a short period of time as we analyze and evaluate the investment. And then once the deal is announced, the confidential information that's been shared with us is then released to the public. So we do have an informational advantage when evaluating these deals, and as the valuations of the sector have become more depressed, we're going to be taking more advantage of these deals to get good terms for our investors. In many cases, warrants and other deal sweeteners can be present to enhance returns in those deals. We also have a very robust and leading private equity business. So we have a dedicated team of 50 professionals that provide us preferential access to crossover opportunities and IPOs in OrbiMed companies. So a crossover investment is basically an investment in the last private round prior to an IPO. So this fund has participated historically in crossover deals in the past. Importantly, the Biotech Growth Trust has the option, but not the obligation, to participate in those opportunities. But again, our venture capital colleagues really give us a heads up on what's coming down the pike in terms of new IPOs that are coming to market. They also aid in diligence for both the IPOs as well as our other publicly traded names. And importantly, they actually have regular interactions with the business development teams of all of the large pharma companies out there. And so they glean from those interactions what those big pharma companies are interested in from an M&A perspective, and that can help guide our public investing as well. And lastly, obviously, we have a lot of extensive experience as a healthcare specialist firm over the past 25 years investing in biotech. So let me now turn to performance, starting with a review of the last fiscal year. Here's a graph showing the Biotech Growth Trust performance for fiscal 2025 and the 3 months after the end of the fiscal year. You can see that this graph starts at March 31st, 2024, and we have a black dotted vertical line showing the end of the fiscal year, March 31st, 2025. You can see that the Biotech Growth Trust NAV in blue was basically performing in line with the index for the first half of the fiscal year, but then unfortunately had a relative decline versus the index for the second half of the fiscal year. And after the fiscal year closed, we're still in the midst of recovering that performance gap. So I'm going to explain exactly what drove that performance. And one of the chief factors is how this portfolio is really constructed. So here on the lower left-hand side of this graph, you can see a table which shows the portfolio constituents of the Biotech Growth Trust classified into three market cap categories. Large cap stocks above $10 billion in market cap, mid cap stocks between $2 and $10 billion in market cap, and small cap stocks less than $2 billion in market cap. And if you compare the portfolio distribution among those market cap categories of the portfolio versus our benchmark index, the NASDAQ Biotech Index, you can see that we began the fiscal year being significantly underweight large caps and significantly overweight small caps versus our index. If one then plots the average stock price return for the index constituents in each of those market cap categories, you can see that small cap stocks in gray and mid-cap stocks in green did underperform large cap stocks in blue over the course of the fiscal year. And obviously, since we were positioned to be underweight large caps and overweight small caps, that was a headwind to relative performance versus the index. We did end the fiscal year with the positioning shown in the upper right-hand corner of this slide. Again, underweight large caps, overweight small and mid caps. We did take down leverage a bit towards the end of the fiscal period due to the volatility in the market. But since that time, we've levered up again, and we're now close to 10 to 11% leverage right now in the portfolio. So another dimension that I think it's important to emphasize that accounts for the performance we've had this past fiscal year is just comparing the performance of companies with product sales versus those that are pre-revenue. And so that's what we've done here on this graph. Morgan Stanley has actually constructed two biotech company baskets. The first one in blue is what they call the commercial biotech basket. And the second one in light green is what they call the clinical stage biotech basket. That's basically the pre-revenue companies. And you can see that over the course of the fiscal year from March 31st, 2024 to March 31st, 2025, the pre-revenue companies actually underperformed the biotech companies with product sales by over 40%. How were we positioned going into this fiscal year? That is shown in the table in the lower left-hand corner of this slide. You can see the percentages of revenue versus pre-revenue companies in the trust versus our benchmark index. And you can see that we were basically underweight revenue companies and overweight pre-revenue companies, as you might expect given our small cap bent. So that obviously was also another headwind to performance versus the index over the fiscal year. So that, of course, begs the question, well, why are we overweight small caps and pre-revenue companies? And this slide here illustrates one of the chief reasons why we are emphasizing that portion of the biotech universe in our portfolio. So this is a chart actually showing a number of indices performance in British pounds for the past 4 years, since March 31st, 2021. You can see at the top of the chart in gray, the S&P 500. It's delivered a 67.5% performance since March 31st, 2021. Right below that in navy blue is the S&P 500 Healthcare Index. This just consists of the healthcare constituents of the S&P 500. You can see that that's actually underperformed the broader S&P 500 over the past 18 months. Below that is the Russell 2000 Index. This is a broad market-wide index that consists of small cap companies across the market. And you can see that in general, over the past 4 years, small caps have really underperformed large caps. It's not specific to biotech. This has happened across all sectors of the market. But the one index that I'd really like to emphasize is the one at the very bottom in green, and that is the Russell 2000 Biotech Index. That's a small cap biotech index, and you can see that over the past 4 years, this particular index has underperformed the S&P 500 by an astounding 115%. We think this is completely unjustified due to the strong industry fundamentals we see in the sector. This is unprecedented in terms of its severity, and it's unprecedented, frankly, in terms of the duration. So any time that we've seen in the past, small cap biotech underperformed the S&P 500, there's usually been a nice recovery period afterwards. And in this particular case, again, unprecedented. We've been in this 4-year, basically protracted bear market for small cap biotech. Now, why do we believe that we should see a recovery hopefully in the next few months? The reason why we have conviction in that call is because if you look at what this latest drawdown in biotech has done to the sector, it's really driven absolute valuations to unprecedented lows. And one simple way to look at valuation for the sector is simply to take the median ratio of the market caps of these companies and compare them to the net cash that these companies have on their balance sheet. And if you plot that very simple metric, you can see that this latest drawdown has really driven absolute valuations for the sector to record lows. We've never seen valuations this low. We're trading at levels below the dot-com bust, below the great financial crisis, below Hillary Clinton's election campaign in 2015 when she talked about lowering drug prices in the United States. So really, really unprecedented lows, and we just don't think that is justified or sustainable. Another way to look at that, if you look on the next page here, the percent of biotech companies now trading at market caps below the net cash on their balance sheet is shown on the left. So 20 to 25% of the entire industry is actually trading at market caps below the net cash on their balance sheet. We've never seen anything like that before. You can see it in historical context, how anomalous and unusual this state of affairs is. And that translates on the right to about 100 companies that are now trading in the public markets at a valuation below the net cash on their balance sheet. So really, really unusual. We don't think this is justified, and we do think eventually this will correct back to the historical averages. So here's sort of the long-term chart of the Biotech Growth Trust performance since our inception as managers in May of 2005. Again, you can see the NAV in blue, the benchmark index in gray, and the FTSE All-Share Index in light green here. You can see that up until the end of 2020, we actually had pretty good performance, good excess performance versus the benchmark, but it's really this unprecedented drawdown that we've never seen before in 2021 that has really taken down performance quite a bit. And unfortunately, the recovery that we've been expecting and are positioned for has not happened yet. So the central message I'd really like to deliver in this presentation is the fact that the valuation contraction that we've seen over the past 4 years is really unjustified. It's really disconnected from the strong industry fundamentals in the industry right now, and I'm now going to walk through some of those investment themes. So innovation is really the principal driver of value creation for the biotech sector, and I'm happy to say that the state of innovation in the sector is at an all-time high. Here is just a table showing key breakthroughs in biotech since our last annual general meeting, at shareholders meeting. And you can see a number of breakthroughs on this slide. I'll just highlight a couple of them. The first one on the list, Akeso Bio. This is actually a Chinese biotech company, and they have signed a partnership with Summit Therapeutics, a US biotech company, to co-develop a first-in-class novel PD-1 VEGF bispecific antibody called ivonescimab. And recently, in a large phase 3 trial, this particular antibody showed a 49% reduction in disease progression in lung cancer patients versus the standard of care, which is Merck's blockbuster drug Keytruda. So this is a tremendously significant clinical result, great for lung cancer patients. We do expect that if this drug makes it to the market, it will become a mega blockbuster drug. Just another example, the second one on the list, Gilead Sciences. They recently got approval for a drug called lenacapavir. This is an injection that you take every 6 months, and it's basically used for pre-exposure prevention of HIV. If you take this injection every 6 months, basically regardless of your sexual activity or habits, you will not get HIV. So again, a tremendous medical breakthrough, and all these medical breakthroughs are making their way to biotech products that are on the market. So here is a list of significant FDA biotech product approvals since the last AGM. I won't go through each of these. Some of them are for smaller indications like congenital adrenal hyperplasia. Some of them are for larger indications like moderate to severe pain. But if you look on the very right-hand column of this slide, you can see the word first in bold for every single one of the entries on this table. And that is because every single one of the drugs on this slide is groundbreaking in some way, either because it's the first to be approved with a novel mechanism of action, the first to be approved for a particular disease, but a lot of great innovation happening in the space, and that's creating a lot of value for biotech companies. So just to highlight one therapeutic area where there's been quite a bit of innovation lately, I'd like to highlight oncology. So cancer actually remains the #1 therapeutic area for biotech drug development, given the significant unmet need for this disease area. So here in this slide are just a number of novel technologies that are being applied to develop cancer therapeutics. We have cell therapies, we have antibody drug conjugates. These are antibodies that are actually fused to a chemotherapeutic. The antibody will bind preferentially to cancer cells and deliver chemo straight to the cancer to kill those cells. We have bispecific antibodies. These are antibodies that are capable of binding to two different targets at the same time. So one of the targets it binds to is the cancer cell, and the other branch of the antibody actually binds to an immune cell. So it brings the immune cell close to the cancer cell so the immune cell can recognize it as having deleterious effects and will kill the cancer cell. So that's another very interesting technology that's had a lot of success. We have targeted therapies. These are therapies that are geared towards cancers with specific genetic mutations. We have radiopharmaceuticals. Again, this is a very novel methodology where you take a targeting antibody or ligand, you fuse it to a radioisotope, you inject it into the body. Again, it targets that radiation directly to the tumor site. And then lastly, cancer vaccines. This encompasses a number of different approaches where you stimulate the immune system to eradicate the body of cancer. So multiple innovative approaches generating clinical benefit across tumor types and giving physicians more treatment options to extend the lives of cancer patients. And so if you look further out, what's the future for oncology therapeutics? And we have a general slide here outlining some future trends that we expect to occur. So basically, we think we are going to be able to move cancer from a death sentence to more of a chronic disease that can be managed and hopefully cured. We have learned a lot about the biology of cancer over the past 20, 30 years. It's important to note that cancer is not one single disease. There are actually over 200 different types of cancer. And so we've learned a lot about how each of these different cancers work, what the mutations are that drive each of these different cancers. And so we do expect an acceleration in the number of cancer drugs making it to market over the coming decades. And that's really going to be driven by three trends here. Number one, novel screening technology and molecular diagnostics. So our ability to detect cancer early is improving dramatically. The earlier you detect cancer, the easier it is to treat and to cure. Secondly, our ability to sequence these different cancers is improving as well. So right now, if you're a cancer patient, it's become standard of care that they will generally sequence the cancer cells in the body to determine which mutations are actually driving that cancer. And then based upon that information, we're coming up with tailor-made treatments, customized treatments that are personalized for that particular patient's cancer. So rather than a one-size-fits-all solution, we're moving to a one-size-fits-one solution. So it's personalized drug treatment for cancer that hopefully will lead to a lot more cures in the years ahead. Another area where I think we're ripe for a lot of technological advancement over the coming years is gene and cell therapy. These are mostly applied to diseases that develop due to a genetic mutation. And we do think we are on the precipice of an explosion of new gene therapy medicines making it to the market. So today there are only about 30 gene and cell therapy products approved by the US FDA. The first one was approved about 8 years ago. Since that time, the safety, efficacy, and ease of administration of these therapies has improved dramatically. And so we do think over the coming years, we are going to see multiple-fold new gene and cell therapy products making it to market. And the great thing about these drugs is that they're meant to be one-time curative therapies. So if there's a disease that's caused by a genetic mutation, you put in the gene therapy, it corrects the genetic defect, and then you're done with treatment. So that's the idea, and we think we're going to see significant advances in this area in the coming years. So as a shareholder in the Biotech Growth Trust, you do get exposure to a nice cross-section of all of these novel technologies in biotechnology. Here is a slide showing a number of those technologies, as well as the percent NAV exposure in the portfolio to those technologies. So great exposure to all these technologies and great innovation really happening across the space. Moving on to the regulatory environment, we have had a very positive, constructed regulatory environment at the FDA for the past several years. Here is a graph showing the number of new drug approvals at the FDA since 2016. You'll notice a nice bump up in 2017. That was actually the first year of Trump's first term, And he was very encouraging of the FDA and wanted more drugs to be approved basically at the FDA. And so we've had a very favorable regulatory stance since that point in time. And you can see that the number of drug approvals per year has remained at an elevated level through Trump's first term, through Biden's term, and now we expect through Trump's second term. So very favorable regulatory environment, a lot of flexibility on endpoints. FDA really wants to get these treatments to patients as quickly as possible. Moving on to M&A. M&A has been a historical driver of returns in the biotech sector. And so here at the top, we have a graph here showing the number of announced public biotech M&A transactions since the beginning of 2018 on a quarterly basis. You can see that there was quite a flurry of M&A in 2023, a little bit of a lull in the back half of 2024 as those large companies digested the acquisitions they made in 2023. But encouragingly, you see the last two columns on this slide in the first quarter of 2025 and the second quarter of 2025, we're seeing a nice uptick in the number of M&A transactions announced. And if you look at the lower left-hand corner of this slide, we have a number of selected quotes from big pharma CEOs from their first quarter earnings calls talking about the importance of M&A to their respective company strategy. So there's a lot of appetite for M&A. On the lower right-hand corner, we have a number of examples of recent M&A transactions where the Biotech Growth Trust actually owned the target company at the time of acquisition announcement. So as a shareholder, as an investor in this fund, you will directly benefit from this M&A activity. Now, one of the principal drivers of this M&A has been the fact that big pharma is facing the loss of exclusivity of a number of their blockbuster drugs. So here on the left-hand side of the slide, we have a graph showing the branded sales at risk of basically these big pharma blockbuster drugs facing either generic or biosimilar competition by the end of this decade. We estimate nearly $270 billion in branded sales at risk of loss of exclusivity. If you look on the right-hand side, we've listed a number of examples of those blockbuster drugs. So for example, Merck has their blockbuster cancer drug, Keytruda. It delivered close to $30 billion in sales for Merck in 2024, and it's expected to lose exclusivity in 2028. So how is Merck going to fill that revenue shortfall? They're going to acquire biotech companies. So we do expect accelerated M&A activity through the back half of this year, and hopefully we'll all benefit from that in the portfolio. Now, moving on to the political environment, we have seen some political headlines that have pressured the space in recent months. But I would say overall, we actually think the political environment is very favorable for biotech. So I'll go through some of these points on this slide. So first off, the Inflation Reduction Act. This was one of Biden's signature bills. One of the provisions of that bill was a clause that allowed the government to negotiate prices for Medicare. Trump recently issued an executive order that basically extended the pricing exclusivity period for small molecule drugs to 13 years from 9 years, which is very favorable for the industry. In terms of M&A, Lina Khan was the FTC commissioner under the Biden administration, and she was very aggressive about blocking M&A for antitrust reasons. Now that she is gone, we do think that should pave the way for increased biotech M&A activity. The Trump administration is at core, we believe, a pro-innovation administration that's consistent with Trump's broader domestic pro-business agenda. He wants to reduce regulation. That includes reducing regulation at the FDA. He wants to reduce the regulatory hurdles to drug approvals and really speed up the drug development process. I would say there's really broad-based political support for the industry in Congress. The Senate, for example, just released a bipartisan report that recommended further government support of biotech as a strategically important industry for the country. So that's also very encouraging, obviously. And Trump, obviously, is a very pro-business president. He initiated some or enacted some corporate tax cuts during his first term. He said he wants to do more of that in the second term. We'll see if that happens or not, but obviously, if that does come to pass, that would be great for the industry as well. Now, let me address some of the uncertainties that have pressured the sector recently. The first is the appointment of Robert F. Kennedy to be the head of the Department of Health and Human Services. That scared a lot of investors. He is a noted vaccine skeptic, and I do agree that vaccine development is going to become a little bit more uncertain from here on out, given that he's such a vaccine skeptic. Actually, we exited all of our vaccine positions after he was appointed head of HHS. Having said that, we don't think the drug approval process is going to be affected in a negative way by his appointment. The FDA Commissioner, Marty Makary, seems very science-based and reasonable, and has publicly stated, actually, that he expects in 2025 there to be 20% more drug approvals than in 2024. So hopefully that comes to pass. Budget cuts. So clearly Trump has cut some government spending. Elon Musk, with his DOGE initiative, has also collaborated on that. And yes, there have been some staffing and budget cuts at the FDA. Having said that, again, though, it's important to note that the FDA, as well as the Department of HHS, RFK himself, have both stated that they are not planning to cut any drug reviewers. This in no way is going to hamper the FDA's ability to meet its drug approval timelines. And in fact, what we've observed over the past few months is no significant delay to drug approvals for biotech companies. And then lastly, drug price reform. Trump did announce recently an executive order calling for most favored nation pricing for drugs. What that basically means is that Trump is very upset that the US pays much more for drugs than in Europe, and he would like to basically equalize that pricing between the US and Europe. We think for that to really come into fruition, it really needs to come through legislation, and we think that's very unlikely to pass Congress. Trump actually proposed this idea during his first term, and it basically didn't go anywhere. Secondly, he has announced pharmaceutical tariffs are coming soon. That's mostly going to affect the large commercial pharma companies. Cost of goods sold for these products is typically very low, and I think biotech companies have some time to choose where to manufacture their drugs in the years ahead, depending on how those tariffs play out. But overall, we do think this is more sort of headline risk than real risk to the sector, and the biotech industry should be able to manage through these policies. So overall, we think the positives outweigh the uncertainties for Trump's second term. So let me summarize with the 2025 strategy and outlook. Our strategy is going to continue to emphasize emerging biotech over large cap biotech to really capture the sector rebound that we have been patiently waiting to occur. We are going to continue to capitalize on compelling investment opportunities in companies that need to finance at low share prices. We have shifted the portfolio somewhat to a more balanced allocation between small caps and mid caps for liquidity reasons. And the gearing level you should expect to generally stay between 5 and 10%. Again, the unprecedented low valuations in emerging biotech does suggest significant upside from current levels. The performance drawdown that we've seen in small and mid-cap biotech versus the S&P 500 has been the longest and most severe we have ever seen, such that the percent of biotech companies with market caps below the net cash on their balance sheets is well above historical norms. The valuation levels are now lower than the great financial crisis, lower than that of the bursting of the dot-com bubble. And again, the valuation contraction we've seen, we think, is very disconnected from the fundamental innovation in this sector, which remains quite robust. We do expect M&A activity to accelerate given the lower valuations of biotech targets and the need on the part of big pharma to remedy the revenue shortfall they expect from loss of exclusivity on their blockbuster drugs. And lastly, we think actually the Trump administration is going to be very good to the biotech industry and supportive of the industry as it develops. So with that, the concluding statement here is we really believe this is an excellent time to invest in biotech innovation at unprecedented low valuations. So thank you so much for your time.